is just unbelievable.
Loving the Philly vibes today. Got every Philly reference you're gonna see in like the history of pop culture. I'm so excited to be sitting here with Matt Resch. Are you sure you're not Mike?
I am Mike.
Oh.
We switched this
Oh, geez. All right.
No, I'm Matt.
That's Matt Resch, founder at Ambassador Financial Group, LLC. And Kurt Myers. Hi, Kurt.
Morning.
CEO and Chairman of Fulton Bank, Fulton Financial Corporation, a $32 billion bank based in Lancaster, Pennsylvania.
Correct.
Not far from my hometown of York, Pennsylvania.
There you go.
If you're from the area, you definitely have heard of Fulton Bank. We're going to talk today about not only Kurt's rise to the CEO seat, but a lot of topics, the State of the Union, as we like to call it. And I'm going to turn it over to Matt to get us started.
Yeah, thank you, Brian, and good morning, everyone. I'm delighted to be a part of the next forum this year, both as a sponsor with my company, Ambassador Financial Group, but also obviously as a panelist on the dais. I grew up and was born and raised in Lancaster County, Pennsylvania, so I'm particularly delighted to be on the panel here with Kurt, who runs Fulton and is based and headquartered in Lancaster. We're really excited about this conversation. It's really a continuation of the first section. I also will say that, given Brian's York connections, we have South Central Pennsylvania pretty well represented and covered. So, Kurt, you've obviously managed and navigated many different economic, credit, interest rate, and regulatory cycles over your long and successful career at Fulton. From my perspective, when we talked about the optimism early on, and we heard that in the previous session, it certainly feels like the current sentiment for market sentiment for banks, the operating environment, the overall banking landscape, it feels as good as it's felt in a long time. From a credit perspective, credit issues remain benign for most banks. Net interest margins have expanded and should continue to expand for many banks. The regulatory environment, as we heard, is as friendly and as accommodative as it's been in a very, very long time. It almost sounds like an oxymoron. And on the M&A side, it's very healthy, and we're going to dive into that as well. So we just welcome your perspective on your view and insights on the state of the banking landscape, or the State of the Union, as we like to call it.
Yeah, well, great, and it's great to be with all of you. I learn as much from you all as I share, so I look forward to learning throughout the day as well. And Brian and Mike, Matt, whichever one's up here, I don't know. It's good to be on a panel with you too. So the State of the Union, if you will, for us is pretty constructive. I mean, when you sit back and think about it, we're all bankers. You all plan for all the challenges that we have, and I'm sure they're going to come our way. But when you think about it, we've got margins above historical trends. I mean, they continue to come down, but if margins are above historical trends, credit's pretty stable and solid. So it's a pretty constructive environment for us and the industry. We have a yield curve that's actually shaped the right way right now. It'd be great if it was sloped positively even more. We'll see if that happens over time. It probably will. But as we sit here, the environment's pretty good.
Yeah, we would tend to agree. I mean, it's the optimism that is shared, amongst our clients. Although, Kurt, we've known each other for a long time, and I think you've always talked about in good times, it's never as good as it seems, and in bad times, it's never as bad as it seems. And for those of you in the room who know me, I've stated this often, which is it's always the bus you can't see coming that causes the most damage. And unfortunately, as many in the room know, in the banking industry, the frequency with which that bus tends to arrive over the last 10, 15 years is far more often than we would like. So hopefully this time around that bus stays in the parking garage for a considerable time, so we can really experience a bull market, from a banking perspective. Just a follow-up question, Kurt, is really around, just given the banking landscape, what opportunities do you see on the horizon for Fulton, juxtaposed to maybe what you worry about and the risks you have to manage regularly?
Yeah, when the great thing about or the challenging thing about good times is they come to an end. So things are pretty constructive now. I think there's a lot of positive momentum, and you really got to kind of make hay while the sun's shining. And I think you want to take advantage of the opportunities that you have, no matter what that is. But you always have to be thinking about what's coming. So when things are good, if you think about it, you got more downside risk than you do upside opportunity. So you really have to be thinking about, what could go the wrong way. And there's always things that can go the wrong way for us. I think about the upside. I think business spending is an upside. I think there's a lot of momentum around business spending. I think we should have a pickup in business spending that should then give all of us a little more loan growth on the commercial side. Hopefully it plays out that way, rates down, better tax environment. Like you could really get a positive story around business spending. The flip side is, we've got a pretty fragile consumer right now. When you got 60% of the U.S. lives paycheck to paycheck, and you have some maybe jobs going the wrong way, I think we're really looking at the consumer to see how that plays out. I think there's some potential risk there, but right now we really don't see it, and we're looking hard. I'm sure all of you are looking really hard at your consumer book, and folks are employed if they want to be employed and can be employed, and if they're employed, they're going to pay their bills. So that's pretty positive right now, but it's hard to see that continuing to be as positive. So it's really thinking about that downside. I think the other challenge for all of us that we're leaning into right now is funding. Funding is really what drives enterprise value for our stockholders. It's what gives us the fuel and energy to grow and make loans. And deposits are going to be tougher and tougher because we have some macro things that are happening within the industry that you really need to be figuring out, like what's my deposit base going to look like 3 to 5 years from now? What's that composition going to be? Where can I lean in and get deposits? What's going to flow out no matter what I do? And really looking at that deposit base of your bank, I think is a really critical thing because it is what drives enterprise value and what gives you energy to grow.
Yeah, thanks, Kurt. I think it's interesting because Steve commented on the previous session about the sensitivities that the consumer has and how consumer behavior has changed. From a lending perspective, folks who have mortgage, their psychology is such that if rates fall 25 or 50 basis points, they're going to refinance that mortgage. But similarly, with rates sitting at zero for the longest time, and then obviously, they rose dramatically. The consumers now tend to be shoppers to look for the highest rate, and core deposits are exceptionally important. So the key is the old school community banking relationship building so that you can maintain as many low-cost sticky deposits that you can, but certainly that's a challenge. And that's really, I think, a good segue to the next question, which is, banking in some ways, particularly community banking, has been the same forever. But in many ways, it's obviously very different from technology, product and service offerings. Competition is not only from banks, but non-banks. Again, how to acquire customers. So perhaps, Kurt, you could speak to the evolution of banking over your long and successful career with Fulton, and how you guys approach it. You're a large community bank. You're $32 billion in assets, but I know the story well. It's a large community bank, and so how do you marry the relevancy to your customers and your communities, but in a way that also then enables you to compete with the much larger banks that you compete with?
Well, I'm glad to hear you say large community bank, because it is a little frustrating when they talk about community banks based on size. And the regulatory environment talks that way. I think just the public in general talks about size. We define community banking as taking local deposits, making local loans, providing local services, and impacting local communities. So I started the bank now 36 years ago. It's been a long time. Bank was much smaller. We've grown consistently, and that community bank mindset and strategy is the same as it was when I started. What's changed is how you do it. And that's what we have thought about, and I think what everybody really needs to think about is how do you kind of move forward, grow your organization, but not lose what got you to where you are. And when we think about strategy at community banking, we do think it's scalable. My career's a good example of 36 years, and I feel we're just as much of a community bank as we were 36 years ago in certain regards. There's very few things that we do the same as we did 36 years ago. But when we're moving forward and doing things differently, we always have that mindset of, hey, we're taking local deposits, we're making local loans, we're impacting local communities. How do we do things that we need to for scale, but keep those core tenets of community banking in play? And I think that's why our strategy hasn't changed that much over time, and why I think it's sustainable too, because I get that question around, Kurt, what size does community banking not work? And the way we have things set up, we're just adding markets and we're adding market share, but we do the same thing in each market, and each market's community banking, so we do think that's scalable as we move forward. But certainly, the way you do things and the way we do things has to change for scale and complexity and all of those things. But there is a way to do it and still give that customer experience and customer feel of a small community bank.
Yeah.
I'm going to ask a quick question about scaling as it relates to talent, which is my wheelhouse. You're $32 billion now, but you used to be a lot smaller, and that requires different perspective, different background. Tell me a little bit about the talent strategy to help as you scale.
It's a great question, and talent, I talk about people do everything that we do. So from tech to your frontline sales folks, like people do everything. So you got to think about culture, and you have to be having the talent that you need to go forward. So from our perspective, the first thing we do is talent development. Like our goal for every employee is that they stay as long as they want, and they develop their skill set, and they can do more later. What that is, that's really up to them to figure out and decide, but we want to give them that opportunity to learn and continue to move forward. So we're developing talent internally. However, when you grow to like we have, you can't develop that level of talent over time. So certain things, experience, and within the company don't lead to the skill set that you need if you're a $10 billion, $20 billion, then $30 billion bank. So you have to recruit to fill those gaps. And I think it starts with being really honest about knowing what you're good at and what gaps you have. Because a lot of times you don't think you have as many gaps as you actually do. So internally, we are really disciplined around saying, do we have the people that can get us to that next level in that particular thing? And then if we don't, we're looking at recruiting. And what we like to do is recruit and then develop. So get that skill set and still develop, because what attracts people to the organization is culture and how we do business. So it is still a developmental even when we recruit. So the first thing, even at a senior level, it's recruit and then develop and build, because you want people to understand, know the culture, appreciate the culture, and be part of the culture so that they can develop their career.
This sounds like a good balance of internal and external.
Yeah.
And if I'm not mistaken, you're the fourth homegrown CEO at Fulton, which is pretty extraordinary. So
yeah, I've been very fortunate. I started at the bank in 1990. I was a management trainee, kind of rookie out of college. Really didn't know much about banking at all, and really have had the opportunity to develop over time. They gave me something and I didn't screw it up, so they gave me another thing. And if I didn't screw that up, they added the next thing, and just you kind of develop your skill set over time. And we have predecessors that have done that as well. We still have a management training program, so we hire every year somewhere between 8 to 15 college recruits in a training program, developing them. Our retention rate at year 7, we target year 7, because if you're there at year 7, I think we got a good chance of keeping you to maybe your whole career or the long term. If we don't get you to 7, that's where we have most of our turnover. But we have about 50% retention at year 7. I was one of 8 in my management training class in 1990, and there's 3 of us that still work at the bank 36 years later.
Yeah, I think we pivot to the M&A discussion a little bit. Kurt, obviously, again, the last session talked about it, but the M&A environment seemingly is as healthy as it's been. Deal activity is accelerating. Valuations are improving. The regulatory climate is supportive. Investor sentiment for most announced deals is really solid for the acquirers, currencies, et cetera, et cetera. So, we talked about your growth, but Fulton's been a really impressive growth story that's been a combination of organic growth that's over time you've married that with select and opportunistic acquisitions. The most recent acquisition, of course, was Republic First, through the FDIC-assisted process right here in Philadelphia, which I know was a home run for you all. But I would love to just get your thoughts also for the audience, how you see the M&A landscape, and then how does that impact your growth strategy? And there's a nexus, of course, that you do deals for many reasons. It's for scale, it's for synergies, it's the deal math, but then there's also a talent component that you might be able to acquire talent that complements your homegrown programs.
Yeah, so on the M&A front, it's interesting. You said the M&A pricing's really positive. I'm like, not if you're a buyer. So it is good. Multiples are up. All of our franchises are worth a lot more than they were maybe 2 years ago, and that's a good thing for all of us. But when you're on the buy side of that, it can be a challenge because you got to make the math work. So how we look at M&A, and Republic First is maybe a good example. We're always prepared for it, but we never plan on it. So it is part of our strategy, and we want to be prepared that we can take advantage of the opportunities that come our way. And did we ever plan on doing an FDIC deal? Ever? No. And doing something that quickly and integrating, you don't have the playbook for that. We've never done it, so we didn't have the playbook for it. So you never plan for that. But we do have an M&A playbook. We've got a really good team. We thought we could step in and be a solution, and we were able to do that. So our strategy is to prepare for it, but never plan for it. Overall, again, we're trying to scale community banking. So any bank that we can add and partner with to add to our franchise, to do more community banking in each community, that's what we're focused on doing. So we look at, does it move our market share to a point where we're much more of a significant player? Because when you have more market share, well, guess what? You have more customers, you have more employees, you have more career development opportunity, you have more people to make impact on the community. Like everything that we do directly correlates to market share. So as we get opportunities that we can improve market share in a market, it's really a win-win scenario. You referenced organic growth. So we went from 2005 to 2019 without making an acquisition. We grew organically through that period of time, and we're able to grow organically enough to sustain ourselves through that time, because that's the real key thing. Because even if you do M&A, well, guess what? You got to hold on to those customers. And then your base is a little bigger, so you got to be better at organic growth so that you can grow a bigger organization. So it really comes down to that ability to grow organically, and then the M&A is an opportunity to make your company and move your company forward.
Yeah, thank you. So it's interesting. I think you bring up a really good point around pricing, which folks oftentimes, if you're a seller, you're myopically focused oftentimes on the top line, announced day one deal value. But in most deals, obviously stock consideration represents the lion's share of the consideration. And so if you're a seller and you're receiving currency in that transaction of the buyer, you need, in our opinion, to focus on what upside that represents. And so getting greedy as a potential seller to get a higher top-line multiple that perhaps the buyer stretches on deal math, which the investment community will see through, we think is just too much of a short-term view. And that if you position the transaction appropriately as a buyer, where the deal math makes a ton of sense, it checks all the boxes from strategy, culture, and all the deal math, there's greater value creation that can occur. But that's difficult, oftentimes with folks that are thinking about selling. I think the other thing I'll point out is that, I've been doing this a long time, but, to me, anecdotally, the percentage of bank management teams that are, there's tons of conversations going on up and down the bank size spectrum, obviously. We've seen large bank M&A pick up with Huntington's announced acquisition of Veritex, PNC's announced acquisition of First Bank in Colorado, the Comerica Fifth Third acquisition. So the game of musical chairs is afoot, but the percentage of management teams who are seemingly willing to go in either direction is at the greatest percentage I've ever seen. Obviously the head down's focused on the organic growth strategy, but if there's a combination and a partnership that makes sense, they'll go up, find an upstream partner. But if that's not available and there's not the right deal, then they're going to be opportunistic like yourself. And I would just like to pivot it over to, again, the talent kind of aspect of the M&A game, Kurt, for you guys.
Yeah, so you're always adding new perspective, new talent to the organization. Any acquisition you make, no matter what the size is, it could be really good community bankers, which really drives our business. But you might have a smaller bank that has done some cool things in technology that maybe adds to our technology team. So it's definitely a piece of the puzzle for us. What is the talent pool that we're getting? How do we integrate? Because again, we look at the long-term value of the combination. The deal's got to make sense for both sides, so you got to do your deal math when you do M&A. But we're a 143-year-old company, so we got a long view, and we look at M&A as is our company and the company we're buying going to be better in 2 or 3 years than they are today? And those are the deals that work. So the deal math doesn't make as much of a difference there. Is if you have synergies that you're going to be better together in a couple years, then that's the deals that you want to do. And that's how we look at it, because we're looking to make both companies better. We're not looking to just make our company better. We're looking to do a deal that combined, we're in a better spot a couple years down the road. But we don't care about the next quarter or maybe 2 quarters. As you work through that, it's where are we truly in 2 or 3 years?
Yeah, thank you, Kurt. We got about 2 minutes left. Do you have another question, Brian?
Well, I was just going to ask you maybe a little lightning round since we only have a little bit of time.
This is the stuff that scares me.
Oh, yeah. Let's go. Now, I'll make it easy for you. I'm curious. I think in our prep, we talked about what you hire for, what you look for in the actual human being. What are you looking for when you hire people?
Yeah, so we're kind of a roll up the sleeves kind of culture. So we want people that want to work hard. They're going to be committed. They're loyal, talented, smart, bring the skill set that we need. But I personally also look for heart too, because as a community banker, you got to care about something other than your career. So the best way to make your career go really well is caring about the people around you, caring about the customers, caring about the community. So, we put heart into our equation. Yeah. And I'll just share a story. We hired an executive a few years ago, and through the interview process, one of the last things, I was having dinner with them, and we were just casually talking, and we kind of tiptoed onto a subject that was, I didn't really know it, but it was very emotional for that person. And we're just talking at a dinner, and he kind of breaks down, talking about it. And I could just see in his eyes that he was like, I just lost this job. I'm here breaking down in front of the CEO that wants to hire me to do all kinds of stuff. And for me, it was this guy just got the job. He's got heart. He really cares about things. Things really impact him. So I thought that was a great kind of personal story that would show character and heart, because that carries through a whole bunch of other stuff. And again, it's great when things are great. You really test your mettle when things are tough. And that resilience and adaptability as a culture is what's gotten us through all kinds of really tough stuff. It's great to sit here with you when things are really good. But I could sit here with you throughout those 36 years when things were really bad at certain times, and it's that kind of stuff that gets you through it.
Well, that's awesome. And we ran out of time, so you got off easy from the lightning round. I had some zingers in here, but thank you so much for being.
I have one final question.
Oh, yeah,
Brian.
go, Matt.
So the Phillies showed a little bit of heart last night to extend the series. So are they going to win tonight?
Well, of course.
Yes, thank you.
Yeah.
All right, thanks everyone.